Disclaimer.
Here's a question. What's worth more right now, a paper contract promising you silver or the actual metal in your hand? If you answered the physical metal, congratulations. You've just identified the most dangerous fracture in modern commodity markets, and it's about to get much worse. On January 8th, silver crashed to $76 per ounce on the COMEX exchange in New York. Just days earlier, it had touched $80. Wall Street traders saw a pullback, business as usual, but while prices dropped on American screens, something extraordinary was happening 8,000 miles away in Shanghai. Physical buyers in China were paying $8 over the COMEX price, not for premium coins or collectibles, for standard industrial bars. And some Asian dealers reported selling silver at $130 per ounce. And let me repeat that number, $130. That's 80% above the paper price that Wall Street claims is the more real market value. This isn't a small discrepancy between regional markets. This is history's largest precious metals decoupling, the moment when paper promises and physical reality stopped speaking the same language. Here's what should grab our attention. This split didn't happen because of panic buying or speculation. It happened because of mathematics, cold, hard supply chain mathematics that's been building for years and just reached a breaking point on January 1st, 2026. That's the day China implemented export restrictions on refined silver. They didn't ban exports completely. That would have been too obvious, too provocative. Instead, they did something far more effective. They slashed the number of approved exporters from hundreds of companies down to just 44. Think about what that means. China controls 60 to 70% of the world's refined silver supply. Our phones, our solar panels, our electric vehicles, our entire green energy transition all depend on refined silver from Chinese facilities. And overnight, the bottleneck narrowed from a highway to a single-lane road. The timing couldn't be worse for Western markets. COMEX inventories of the actual physical silver backing those paper contracts in New York sit 70% below their 2020 levels. Shanghai warehouses just hit decade lows. And now the primary source feeding both exchanges has been deliberately choked off. But here's where it gets even more interesting. While all this is unfolding, Federal Reserve Governor Stephen Miron is calling for aggressive rate cuts in 2026. We're talking 100 basis points or more to prevent a recession. That's a full percentage point off interest rates, potentially more. Under normal circumstances, that would be bullish for silver. Lower interest rates weaken the dollar, make commodities more attractive, drive up prices. Standard playbook. But nothing about this situation is standard because Moran's term expires on January 31st, just 3 weeks from now. His replacement will determine whether the Fed pivots dovish and cuts rates aggressively or holds firm and risks a recession. That single personnel decision could trigger either a silver moonshot or a liquidity crisis that makes March 2020 look tame. And we won't know which until February. Let me put this in perspective. You're an investor with exposure to silver, maybe through mining stocks, maybe ETFs, maybe physical coins in a safe. You've watched silver climb from $18 in 2022 to $80 in 2025. A phenomenal run. Many people are taking profits, playing it safe, assuming the rally's over. But what if the rally wasn't the rally? What if everything we've seen so far was just the warm-up act? Here's the mechanism driving this split and why it matters to every American with a retirement account or savings. When Shanghai buyers pay $130 per ounce while COMEX shows $76, that's not just a regional premium, that's a vote of no confidence in paper markets. Physical buyers are saying, your contracts are worthless, your promises mean nothing. We'll pay double the paper price because we need actual metal and you can't deliver it. That $8 premium in Shanghai isn't speculation, it's a supply chain surcharge. It's what happens when buyers realize there's not enough silver to go around, and they're willing to pay whatever it takes to secure physical delivery before the window closes completely. According to the Shanghai Gold Exchange, this backwardation, when near-term prices exceed future prices, historically signals severe supply stress. We saw similar patterns in 1980 during the Hunt brothers crisis, but that was driven by speculation. This is driven by industrial demand meeting geological reality. The invisible hand of the market is screaming something important right now. It's saying that the 4-decade system of paper price discovery, where most silver trades as contracts and derivatives with minimal physical backing, is breaking down. The system worked fine when supply exceeded demand, when China freely exported refined metal, when inventories were full. But those conditions no longer exist. The supply deficit isn't theoretical anymore. It's showing up in empty warehouses and premium explosions, in the divergence between what exchanges claim silver is worth and what buyers will actually pay to secure physical metal. And here's the kicker that should concern every American watching this market. Industrial users can't stop buying. Solar panel manufacturers need silver to hit their production targets. Electric vehicle companies need silver for their electronics and batteries. Data centers running artificial intelligence need silver for their components. These aren't optional purchases. They're required inputs for industries we're betting our economic future on. So when the supply runs short, these industrial users don't negotiate. They don't wait for better prices. They pay whatever premium is necessary and pass the cost downstream to consumers. That $8 Shanghai premium today could be our higher electricity bills tomorrow when solar installations cost more. It could be our higher EV prices when manufacturers can't source components at reasonable costs. The January 9th date in the story isn't arbitrary. It's the day after silver dropped to $76 while Asian premiums exploded. It's the day traders woke up to realize that the paper market and the physical market had officially divorced. And it's the day the clock started ticking on a question nobody wants to answer. The question is simple. What happens when COMEX runs out of silver to deliver against its contracts? According to exchange data, at current drawdown rates, we're looking at 30 to 45 days of deliverable supply. Maybe 60 days if industrial demand softens, which seems unlikely given production commitments already made for Q1 2026. The math is uncomfortable, but unavoidable. Every day contracts come due. Every day someone demands physical delivery, and every day the inventories that back those contracts shrink a little more. China's export restrictions just accelerated a timeline that was already tight. This isn't doom and gloom prophecy. This is supply chain logistics meeting financial engineering and discovering they're incompatible. For decades, we've run commodity markets on the assumption that paper contracts are as good as physical metal. That assumption is being tested right now in real time, and it's failing the test spectacularly. The $76 COMEX price versus the $130 Asian physical price isn't a market inefficiency waiting to be arbitraged away. It's a warning signal. It's the market telling us that paper promises and physical reality have fundamentally different values now. And the scariest part? Most American investors have no idea this split even exists. They're watching COMEX prices, trusting that number represents true value, not realizing that across the Pacific, the real market has moved on without them. So how do we know this isn't just temporary panic or regional market noise? How can we be certain we're witnessing a genuine supply crisis and not just another commodity rally that'll fade in a few months? The answer is in the numbers that nobody wants to talk about. Numbers that have been building for 5 consecutive years while most investors were distracted by other markets. According to the Silver Institute's World Silver Survey, our global markets have run a supply deficit for 5 straight years. Not small deficits, massive structural shortfalls where demand exceeded new supply by hundreds of millions of ounces annually. In 2025 alone, that deficit hit 230 million ounces. Let me give you context for that number. Mexico is the world's largest silver producer. Their entire annual output is roughly 200 million ounces. So last year's deficit was equivalent to shutting down every single Mexican silver mine for 12 months. That's not a market imbalance. That's a supply chain catastrophe in slow motion. And here's what makes this different from every other commodity squeeze you've seen. 50 to 60% of silver comes as a mining byproduct. It's not the primary target when companies drill. It's what they find alongside copper, gold, lead, and zinc. According to the U.S. Geological Survey, this means silver supply can't scale up quickly even if prices triple overnight. Think about what that means for our economy. Copper miners don't suddenly dig faster because silver prices jumped. Gold operations don't shift focus to byproduct recovery because the market's paying premiums. These are massive industrial operations with decade-long planning cycles, union contracts, environmental permits, and geological constraints that don't care about market signals. So when industrial demand for silver explodes, and it has exploded, supply can't respond. It's locked in by geology and physics, not by human decision-making. This isn't speculation driving prices. This is mathematics running into thermodynamics. The solar industry alone consumed 232 million ounces of silver in 2025, according to industry data compiled by the Silver Institute. That's one industry, burning through more silver annually than the entire supply deficit. Add electric vehicles, add data centers for artificial intelligence, add 5G infrastructure, add medical applications, and you start to understand why warehouses are emptying faster than anyone predicted. But wait, if deficits have run for 5 years straight, where did all that silver come from? How did markets function without collapsing? The answer? Inventory drawdowns. We've been eating our seed corn, liquidating stockpiles built up over decades, and pretending that's sustainable. COMEX warehouses that held 380 million ounces in 2020 now hold barely 114 million. Shanghai Gold Exchange inventories just hit their lowest level since 2015. According to CME Group data, those aren't gradual declines. They're accelerating drawdowns that picked up speed in 2024 and went vertical in 2025. Every month, more silver leaves the warehouses than enters. Every quarter, the cushion gets thinner. And now, with China's export restrictions, the replenishment pipeline just got cut by 60%. Here's where the proof gets uncomfortable. Shanghai's backwardation, remember, that is when near-term prices exceed futures prices, is showing patterns eerily similar to 1980. That was the year the Hunt brothers tried to corner the silver market, drove prices from $6 to $50 per ounce, and created the last major silver crisis. But there's a crucial difference that should terrify anyone comparing the two situations. The Hunt brothers crisis was speculative. It was driven by two billionaires accumulating contracts and squeezing shorts in a purely financial play. When regulators changed margin requirements and the Hunts couldn't meet their obligations, the whole thing collapsed. Silver crashed back down because there was no fundamental demand supporting those prices. This time, according to metals analysts at Bank of America and Goldman Sachs, there's no speculative bubble to pop. Industrial users are the buyers. Solar manufacturers need silver for their panels. There's no substitute that works as efficiently. Electric vehicle producers need silver for their electronics. You can't build the cars without it. Data centers need silver for the AI revolution everyone's betting on. The servers require it. This isn't the Hunt brothers gambling with borrowed money. This is General Electric and Tesla and Microsoft and solar installation companies across our country buying physical metal because their production lines require it. You can't pop a bubble when the demand is driven by physics rather than financial engineering. The lease rates tell the same story. When silver lease rates rise, it means holders are reluctant to lend their metal. They're afraid they won't get it back. According to London Bullion Market Association data, lease rates have climbed steadily throughout 2025, accelerating sharply in December as markets started pricing in China's export restrictions. High lease rates mirror the 1980 warning signs. But here's the difference. In 1980, lease rates spiked because speculators were hoarding metal to manipulate prices. Today, lease rates are rising because industrial users are hoarding metal to keep their factories running. One is a financial scheme. The other is supply chain survival. Now, let's talk about the mystery that keeps analysts up at night, the invisible inventory problem. Chinese customs data shows that China exported more than 4,000 tons of refined silver in early 2025. That's 128 million ounces flooding global markets. Yet during that same period, China only imported around 220 tons, about 7 million ounces. Basic arithmetic says China should have 120 million ounces less silver than it started the year with. But here's the problem. Shanghai Gold Exchange warehouses are nearly empty. Private warehouses that metals traders monitor show minimal stockpiles. If China exported that much silver and didn't import much to replace it, where did all that metal come from? Industry analysts estimate massive unreported private stockpiles must exist somewhere in China. Maybe state reserves that don't show up in commercial warehouse data. Maybe stockpiles held by electronics manufacturers. Maybe military or strategic reserves that aren't publicly disclosed. The metal had to come from somewhere. It didn't materialize out of thin air. This matters enormously for what happens next. If those invisible Chinese stockpiles exist and are large enough, they could come to market when premiums get attractive enough. That would ease the supply crisis, bring physical and paper prices back in line, and give mining operations time to scale up production over the next few years. But what if the invisible inventory doesn't exist? What if China already drew down their strategic reserves throughout 2025 to support their domestic manufacturing boom, and now the cupboard is actually bare? In that scenario, according to supply chain analysts interviewed by Bloomberg and Reuters, Western markets face force majeure delivery failures within 30 to 45 days. That's the legal term for we can't fulfill our contracts because of circumstances beyond our control. Imagine you're holding a COMEX silver contract, and you demand physical delivery as is your right under the contract terms. The exchange looks at its inventory, realizes it doesn't have enough physical metal to deliver to everyone demanding it, and invokes force majeure. They'd likely offer to settle in cash at the paper price instead. But if physical metal is trading at $130 in Asia, while COMEX wants to settle your contract at $76, you just got wiped out by contract fine print. Your investment in silver turned out to be an investment in counterparty promises, not actual metal. This has never happened in modern commodity markets on this scale. Sure, there have been delivery squeezes in smaller markets, temporary dislocations that got resolved, but we're talking about silver, a market that underpins our entire green energy transition, our electronic supply chain, our medical technology, and our defense industry. According to data from CPM Group, a respected precious metals research firm, the current supply situation is unprecedented in the post-World War II era. We've never had consecutive 5-year deficits of this magnitude. We've never had a major supplier cut export capacity by 60% overnight. We've never had COMEX and Shanghai prices diverge by 80%. All three conditions happening simultaneously isn't a coincidence. It's a mathematical certainty producing a predictable outcome. The only question is timing. Let's make this personal. You're planning retirement, and you've got some savings in a broad market ETF. That ETF likely has positions in companies that depend on silver, solar manufacturers, tech companies, mining firms. If silver markets freeze up or prices spike to triple digits, every one of those companies faces margin compression or supply disruptions. Or maybe you work in construction and solar installation is part of your business. When panel prices spike because silver costs more, your margins shrink and your customers delay projects. That invisible supply chain crisis becomes your visible income problem. Or maybe you're just trying to understand why your electricity bills keep climbing, even though solar panels are supposed to make energy cheaper. When the raw materials for those panels double in price, guess who pays? We do. The cost doesn't disappear. It just gets distributed across our monthly bills and hidden in rate increases. The proof isn't speculation anymore. 5 years of deficits are fact. China's export restrictions are fact. Empty warehouses are fact. The 80% premium in Asia is fact. These aren't predictions or theories. They're observable reality, documented by exchange data, customs records, and industrial surveys. What remains uncertain is only the timeline and the magnitude. Will this crisis resolve in weeks or months? Will prices stabilize at $100 or spike to $200? Will invisible Chinese stockpiles emerge to ease the pressure or remain invisible because they never existed? Those are the questions keeping metals traders awake at night. Because the wrong answer to any of them means portfolios get destroyed, supply chains break, and our green energy transition hits a wall made of silver scarcity that no amount of money can immediately solve. Now, let's talk about where prices actually go from here, because the math on this isn't subtle. Bank of America published research in late 2025 projecting silver could reach $135 to $309 per ounce if supply constraints persist. That's their institutional forecast, the number they're sharing with clients who manage billions. But here's what should catch your attention. Those projections assumed normal market conditions and gradual supply tightening. We don't have normal conditions anymore. We have China cutting exports by 60%, empty warehouses, and an 80% premium in Asian physical markets. Bank of America's conservative target might actually be the floor, not the ceiling. Technical analysts studying the 40-year price chart are seeing something that rarely appears in commodity markets, a massive cup and handle pattern that has been forming since 1980. According to classical technical analysis, methodology used by firms like Fundstrat and Market Ear, when these patterns complete, they typically project moves of 500 to 700% from the breakout point. If silver broke out of its long-term pattern around $45, a 700% projection puts the target at $250 to $300 per ounce. Some technical analysts tracking momentum and Fibonacci extensions are forecasting $175 by mid-2026 as a conservative estimate if Shanghai's physical premium forces COMEX to reprice. Now, you might be thinking, those numbers sound insane. Silver's never sustained prices that high. And you'd be right, historically speaking. But silver has never faced this combination of factors simultaneously. We've never had industrial demand this strong, while supply capacity was physically constrained by byproduct mining economics. We've never had the world's largest supplier cut exports during a multi-year deficit. Let me show you how this plays out in the real world. Imagine you're a solar panel manufacturer in California. You've got contracts to deliver panels for installations across the state through 2026. Those contracts were priced assuming silver at $40 to $50 per ounce. If silver hits $175, your input costs just exploded. You can't pass all of that to customers immediately. You've got fixed price contracts. So you either eat the losses and face bankruptcy, or you invoke force majeure on your delivery commitments and face lawsuits. Neither option is good, but one keeps you in business. Now multiply that scenario across thousands of companies in our economy that depend on silver. The ripple effects aren't theoretical. They're mathematical certainties flowing from commodity price shocks through industrial supply chains. Here's where timing becomes absolutely critical. Federal Reserve Governor Stephen Miron's term expires January 31st. That's 22 days from now. His replacement will signal whether the Fed pivots dovish with aggressive rate cuts, 100 basis points or more, or maintains a hawkish stance to fight inflation. If the Fed cuts rates aggressively and the dollar weakens according to historical commodity price correlations tracked by the Federal Reserve Bank of St. Louis, silver typically rallies 15 to 25% for every 10% drop in the dollar index. 100 basis points of cuts could easily knock 10% off the dollar's value against major currencies. That alone could push silver from $80 to $100 even without supply pressures. But we have supply pressures. Massive, unprecedented supply pressures building in February and March 2026. Shanghai Gold Exchange inventories, at current drawdown rates documented by exchange officials, have 30 to 45 days of deliverable supply remaining. Maybe 60 days if industrial demand softens, which seems unlikely given that Chinese manufacturers are ramping production for 2026, not scaling back. The calendar math is uncomfortable. 30 to 45 days from early January puts us in mid-February to late March. That is the same window when China's export restrictions fully activate for Q1 2026. The 44 approved exporters will be operating under strict quotas and government oversight. According to interviews with Chinese metals trading firms published in Asian metals industry journals, many exporters are choosing to serve domestic customers first, rather than risk running afoul of new regulations by prioritizing foreign buyers. So we've got Shanghai running out of deliverable inventory, just as the primary source of new supply gets choked off further, right as Fed policy might shift dovish and weaken the dollar. 3 catalysts converging in an 8-week window. The paper-physical arbitrage that's currently showing an 80% premium could collapse spectacularly in either direction. Either COMEX credibility evaporates and Western exchanges are forced to reprice to Asian physical levels, or somehow massive physical supply materializes and brings Asian premiums back down. Let me be clear about what COMEX repricing to Asian levels means for your portfolio. If you own paper silver through ETFs like SLV that trade on COMEX pricing, and COMEX suddenly has to acknowledge that physical silver is worth $130 instead of $80, your position just gained 62% overnight. But if COMEX invokes force majeure and settles in cash, you get $80, while physical holders get $130. The contract fine print determines whether you win big or get wiped out. According to CME Group's contract specifications, force majeure is technically possible under extreme circumstances, though it's never been invoked for silver in modern history. But we're in uncharted territory where normal rules might not apply. The binary outcome should be obvious by now. There are only 2 ways this resolves. Option 1, COMEX regains credibility by delivering massive physical supply. That means convincing major producers, Mexico, Peru, Chile, China, to dramatically increase output. According to mining industry timelines published by S&P Global Market Intelligence, bringing new silver production online takes 8 to 12 years from exploration to first pour. You need geological surveys, environmental permits, infrastructure development, equipment procurement, and workforce training. Nobody's starting that process now because of a price spike. The mines that would ease this crisis in 2034 needed to break ground in 2022. We are 8 to 12 years too late for the supply response that would make this problem go away cleanly. Option 2. Paper silver becomes irrelevant and physical scarcity drives triple-digit prices. Industrial users and investment buyers abandon COMEX and Shanghai paper contracts, demand physical delivery or buy from physical dealers, and pay whatever premium is necessary to secure actual metal. The paper markets don't disappear. They just become price discovery mechanisms that nobody trusts for actual transactions. We've seen this movie before in other commodity markets. Rhodium, a platinum group metal used in catalytic converters, traded at $2,000 per ounce on paper markets in 2019, while physical buyers paid $4,000 for deliverable metal. The paper market persisted, but became irrelevant for anyone who actually needed the metal. If silver follows that path, according to Precious Metals, analysts at TD Securities and Metals Focus, we're looking at sustained triple-digit prices until supply catches up, which, remember, takes 8 to 12 years. That's not a spike and crash. That's a structural repricing of a commodity that's been undervalued relative to its industrial importance for decades. Think about what that means for our energy transition. Solar panels need silver, electric vehicles need silver. The AI revolution needs silver for data centers. Our military technology needs silver. Medical devices need silver. 5G infrastructure needs silver. We've committed our economic future to technologies that require a metal we don't have enough of, and we're only now discovering that reality. The 150% gain silver posted in 2025, from $32 to $80, wasn't the rally. That's the thesis here. That spectacular move that made silver the best performing major commodity of 2025 was just the market waking up to the supply deficit reality. It was the warm-up act, not the main event. The main event happens when either COMEX runs out of deliverable inventory and forces a reckoning, or Shanghai's physical premium becomes so extreme that Western buyers abandon paper markets entirely and drive a repricing that makes everyone question why we ever trusted paper contracts in the first place. Compare this to other recent supply chain breakdowns. Remember lithium prices in 2022? They spiked from $15,000 per ton to $80,000 when EV demand exceeded mining capacity. That was a 500% move in 18 months. Lithium eventually came back down as new production came online, but it took 2 years of high prices to incentivize that supply response. Rare earth elements face similar dynamics. China controls 90% of processing capacity, periodically restricts exports for strategic reasons, and prices spike dramatically until buyers diversify supply chains, a process that takes 5 to 10 years. The pattern repeats: strategic commodity, concentrated supply, export restrictions, price spike, slow supply response. Silver is following that exact playbook. except the scale is larger and the stakes are higher because silver underpins more of our economy than lithium or rare earths individually. And silver's supply response timeline is longer because of the byproduct mining constraint. You can't just open new silver mines when most silver comes from copper, gold, and zinc operations. If you're wondering what to do with this information, the answer depends on your situation. If you're investing for retirement decades away, structural silver scarcity might mean exposure through mining stocks or physical holdings makes sense, but you'd need to evaluate your own risk tolerance and time horizon. If you're running a business that depends on silver, you should be having urgent conversations with your procurement team about forward contracts and supply security. If you're just trying to understand why your costs keep rising, well, now you know. When commodities that we've taken for granted become scarce, the costs don't disappear. They get distributed across the economy through higher product prices, disrupted supply chains, and delayed projects. The February-March 2026 window will tell us which path we're on. If invisible Chinese stockpiles emerge and ease the pressure, if Fed policy remains neutral and the dollar stays strong, if industrial demand softens unexpectedly, maybe we get a breather and this crisis gets pushed down the road another year or two. But if Shanghai runs out of deliverable inventory, if China's export quotas bind tighter than expected, if the Fed cuts aggressively and weakens the dollar, we're looking at a market dislocation that makes 2025's 150% gain look modest in hindsight. Remember the question from the beginning? What's worth more, a paper contract promising you silver or the actual metal in your hand? Shanghai answered that question at $130 per ounce, while New York said $76. An 80% disagreement between the world's two largest silver markets is not noise. It's a signal that the 4-decade system of paper price discovery is breaking down in real time. We're watching history unfold. The day silver markets split in two wasn't some distant past event. It's happening right now. And what comes next will either be a fascinating case study in how quickly supply chains adapt to scarcity, or a cautionary tale about what happens when our financial engineering runs ahead of physical reality. The math says we're about to find out which one, and we won't have to wait long.